Battling banks, rising rates and falling prices, the credit crunch putting the bite on investors.
Okay, I've been meaning to talk about residential property as the investment grade investment or asset class. I do not believe it to be an investment class. I think that I'm going to try and not be nasty or all-knowing, but I think that the property investors have not done any due diligence as far as the property class. When they said, I'm going to shove $500,000, $950,000 into this one property or a few properties, depends where you're looking, their only calculation and knowledge about the property investment was that they know that the property never goes down. Now, this is obviously a wrong assumption because nothing never goes down. Everything goes up and down. But what investors are going to learn soon is that exactly that reality of any sort of investment. Now, I'm not saying that people didn't research the property that they were buying, as in whether it's worth it and did all the inspections and all that. But when they decided to buy into property, that was the only thing they ever said. It's going to continue to go up, and then they would give themselves a reason as what you would call a fundamental analysis, and they were fed like the immigration, the lack of supply, the you got to live somewhere, that sort of stuff. Another thing is that when you are looking to buy anything, you normally do charting. You do a technical analysis, but no one's ever done that because the property only kept going up, and the data that we are getting from the properties being sold and the purchase price is normally lagging, as we saw in one of my videos, 3 to 6 months. So you can't really tell what's going on in the short-term past. And last but not least, that the property so-called investors thought they were so smart that they bought properties 5 years ago, 10 years ago, 20 years ago, and they made money because that was such a good decision. And you know what? It was. Now, it was nothing to do with their research, with them being wise investors. It's everything to do with the cycle. And the cycle's ended. And as we know, cycles ended in about 2017. So it's about a year and a half from now. In the past is that when the property saw its peak. Now, once again, I found this really good report for you, and it's going to confirm what I have been thinking for a long time.
The tables have well and truly turned on property investors. Helped by favourable tax concessions and banks willing to lend, investors easily outgunned first home buyers during the property boom just 2 years ago. Now this group finds itself in a perfect storm, and conditions are the worst they've been for the best part of 20 years. Here's finance correspondent Philip Lasker.
Building wardrobe and...
Bulgarian refugee Michael Iliev has been a property investor for 20 years.
Oh, okay, this is the kitchen. That's right, yeah, that's the kitchen area. So
he says since the regulator crackdown and Royal Commission, a long, trouble-free borrowing record with his bank counts for nothing.
let's make your life really hard to let you know that you're not as good as what you think.
Mr. Iliev says banks are going to absurd lengths.
I mean, just the fact that they're asking you, how much you're spending on your Netflix, how much toothpaste do you use?
The organisation representing property investment professionals like mortgage brokers and lawyers is bracing for a tough year.
So far as borrowing money is concerned, this is the worst that I've seen it. It wasn't this bad during the recession of the 90s, and it certainly wasn't this bad straight after the global financial crisis.
Borrowing money isn't the only problem. When they do have a loan, investors are paying much higher interest rates than owner-occupiers. The difference is 57 basis points on average.
So it's a bit of a perfect storm in many ways, and also investors are also facing unprecedented levels of supply coming into the market.
Oliver Tatani is seeing it. His company, Colliers International, sells a lot of apartments off the plan, and buyers, many of whom are foreign and domestic investors, are disappearing.
Out of the 10 buyers per apartment that may have been there 12 to 18 months ago, you might be down to 5 or 6 now. So I still think there are buyers out there. Will it remain difficult over the short term? Absolutely.
Mr Tatani is convinced the softness is temporary, but two things need to happen.
The banks need to loosen the belt a bit. I think China needs to come back into the picture.
The increase in supply means cashed-up investors can pick up bargains, but at the other end of the spectrum, some are at risk.
Those new investors to the market who bought around the market peak and are already potentially either in a negative equity position or close to negative equity, they're probably the market segment that's at most risk of having to sell or being in a distressed situation.
Investors account for 42% of the value of overall new mortgage demand, so it's a big part of the overall market.
If we do start to see investment demand sliding further from here, which is certainly highly likely, then we are going to be seeing a lower demand profile for Australian housing right at a time when we're moving through peak levels of new supply moving into the market.
Investor lobby groups are also bracing for the federal election.
Assuming Labor gets in and assuming they implement their changes to negative gearing and capital gains tax is going to have a big impact not only on property investors but property as well.
It's really only the federal government forecasting Armageddon if Labor winds back the negative gearing and capital gains tax concessions. Most see other risks that could force investors to leave the market en masse.
The only reason we'd see investors moving into a distressed situation or for sellers is if we did see mortgage rates moving higher. That seems unlikely at the moment, particularly across the majors who are much less reliant on overseas funding costs, or if we started to see unemployment or labour markets weakening substantially.
Property investor Michael Iliev can wait it out.
Give a couple of years and I think probably things will get a lot better.
But right now, Mr Iliev is struggling to convince the bank to extend his interest-only loan because he makes use of negative gearing.
I'd rather keep the money for principal in my pocket because then I can reinvest and I can do the things. Sitting principal into investment property with a lot of equity is just a dead money.
No matter what the outcome of his bank battle, Mr Iliev will be one less buyer in the market.
Totally. One less buy in the market means there'll be fewer people wanting to buy, looking to buy. There's less competition. And yes, if you saw my last video, he also said, give a couple of years, it's all going to come back. Same as the other man who said that it's only short term. He also said something that it possibly can happen, that the banks need to loosen up lending once again. Fair enough, that's possible to happen. And then he says China needs to come back to the market. What does that mean? We're gonna demand that Chinese think that it's a good idea to buy Australian residential property when they don't think that anymore, and the government's changed the rules on them, so it's really not viable for them to buy. I don't know what he meant by that. China needs to come back. If China needs to come back into the market, then the market's not coming back ever. Ever is a long time, but for a long time. In any case, I hope you got my point. I hope you are well. Thank you for watching, and we'll talk again next time.